thing. Most funds will not close to new investors. Why?
They want your money.
Yeah, I mean, the more money they collect from you, remember, they don't make most of their money the way you do. If you invest in their fund, you make money based on their performance. You don't make money based on how much you give them, but they make money based on how much you give them. That's how funds make money. So many mutual funds, they're not focused on performance, they're focused on gathering assets. That's why they advertise. The only reason they want performance, or I don't want to be that cynical. In many cases they want performance because it will help them advertise to get more of your money, okay? But if a fund closes, that is a strong sign, if they don't close too late, sort of like after the horse is out of the barn, that's a strong sign that the fund is shareholder oriented. Some of the best funds some of the best funds out there will close to new investors when they get to a certain level. The reason they do that is because for many funds, the manager can do a good job when they have, they're managing, let's say, 100 million. I'm just going to pick a number. And they can do a really good job with 100 million. But once they get 100 billion, they can't manage that money as well. It's not as easy. I mean, Warren Buffett said this several times with his company. He said, don't expect the future returns to be as good as it's been in the past because I'm managing a lot more money. You can't do it as well when you manage so much money. So if a fund closes, that's a very, very positive sign. Okay?
And then later on it reopened again.
Yeah, and that could happen. I mean, so during the financial crisis, because everybody was withdrawing from funds, right? Everybody was cashing out. So a lot of these funds that had big asset bases, they shrunk. Because if they were closed, they had no money coming in, and yet they had to still redeem people that wanted their money.
Okay, makes sense now.
Yeah. But that's actually the reason that a lot of funds, and this is why one of the things in your outline, it talks about how past performance is not reliable in predicting future performance. And the reason that it's not reliable is because of this asset size issue. Many funds have these great track records, and then they get very large, and they cannot perform at the same level that they could when they were smaller. Okay? So that's something else to look at, is asset size. Okay, in terms of comparing funds, or in terms of looking at performance, you've got to consider the type of fund you're looking at. What's sometimes called in the prospectus, it's called the objective, or if you look on Morningstar, which is a great, this is a great source for mutual fund research for people that want to do it themselves. Morningstar.com. I think for $100 a year you can get a premium subscription. You get all kinds of good research on the funds. They have their categories of funds. And I'm just going to give you just a quick example here. I just looked up a couple random Fidelity funds here. Fidelity has a fund that, these are not funds I'm recommending, by the way. I mean, I don't use these funds. I'm just using them for illustrative purposes. Fidelity has a fund called Contra Fund. It invests in basically large, primarily U.S. companies. Okay? Fidelity has another fund that is called Fidelity Emerging Markets Fund. Emerging Markets Fund. Okay? And I looked at the returns for the last 5 years, as of March 31st. The 5-year return on Contra Fund was 4.91. And the 5-year return on emerging markets was 6.93. Now, which manager did a better job? Well,
the timing.
yeah, see, we've got apples and oranges in a way, right? These are different types. Emerging markets, I didn't say this because it's kind of obvious, but emerging markets invest where? In emerging markets, right? What are a couple examples of emerging markets? Brazil, China, Latin America, whatever. Not the typical large U.S. companies. So what we need is something to compare these two. So if you compare the contra fund to the index that it uses, which is the S&P 500, the S&P 500 during the last 5 years achieved a return of 2.62%. Sorry, guys, I keep...
No, you're good. You're good.
Okay. And the Emerging Markets Index is a Morgan Stanley Capital Emerging Markets Index. That had a return during the last 5 years of, we'll call this EM Index, 11%.
Wow.
So which manager did better, contra fund or emerging markets?
Emerging market.
Contra fund, right? Better than the index,
Oh, I see.
right?
Oh, I see. Yes,
Yeah. You see, they underperformed. Even though their return in absolute terms was better, relative to the index, they didn't do a very good job at all, right? I mean, you could have just invested in the index and had that.
How do you find out what the index is when you're looking at the results?
Yeah, so what you do is you look at, sometimes in the prospectus, but certainly in the annual reports of the funds, when they report their performance, they always report it compared to an index.
Okay.
And they get to pick the index, so they have no excuse for not performing as well as the index, right?
Huh.
So if you're looking at it, you get a prospectus, it'll be in there too.
Yeah, prospectuses sometimes show performance and sometimes not. Yeah, so it's important to go beyond the prospectus. One of the things you want to look at is annual reports, quarterly reports, and things like that for the fund, not just the prospectus, because that'll kind of, the managers will give some commentary. You can see some subtleties, whether they, are candid about mistakes they made and things like that. And I'll give you another thing that you should look at too. Another thing when you're looking at this has to do with returns, but I want to make one comment when you're looking at the risk of a fund. The risk of a fund. You've got to compare with how risky, you've got to distinguish between how risky a fund is and how much risk it adds to your portfolio. Okay? So for example, what's considered riskier, stocks or bonds?
Stocks.
Okay. Stocks are riskier than bonds. Now let's say you have a portfolio that's all bonds. And I'll be brief on this because I know you're going to probably do more of this in future weeks. You have all bond funds in your portfolio. Now, if you add a stock fund to this portfolio, it was all bonds, you add a stock fund in there, do you think that lowers the risk of your portfolio or increases the risk?
Increases.
It lowers the risk because you've diversified now. Okay? And it's the same thing when I mentioned gold previously. Precious metals are very volatile, very risky. But if you add them to a stock or bond portfolio, they may lower the risk by giving you diversification. So I just want to make that quick comment that you can't look at the risk of a fund in isolation. You've got to look at it in the context of the portfolio, and I think you'll be doing that in more detail. The only last thing I was just going to mention is one other thing that I like to know with mutual funds is I like to know, does the manager have his or her own money invested in the fund? Wouldn't you say that's important?
Yes.
Okay?
How do you find that out?
Yeah, that's what I'm going to tell you right now. Until about 3 or 4 years ago, there was no way to find that information out. Some voluntarily reported that, most did not. Now there is a way to find it out. It's in something called, it's a document that most fund companies have on their website, and if they don't have it on their website, you can call them and request it. It's called the Statement of Additional Information. Okay? SAI. Find out if your manager has money in the mutual fund they're running, right? Their interests are more likely to be aligned with yours. And I mean, it should be a meaningful amount, right?
Oh,
They tell you how much.
They give you ranges, okay, like 0 to 10,000. It goes up to $1 million, and then it says over $1 million, right? These guys make good money. So if they have 0 to 10,000 in their fund, that's like 0, okay?
That's a great, great question.
And if you're working with an advisor, I don't care if it's a broker, a fee-only advisor like me, ask them that question. If they don't know the answer to that question, then, you know.
If they don't have their money invested the way they want to invest your money, you shouldn't be doing business with them. I just want to summarize just a little bit for mutual funds. If you're going to go the index route, there is nothing wrong with that. Go to Vanguard. Well, you were going to mention a couple of T. Rowe Price, would you mention?
Oh, yeah, I'm sorry.
Fidelity?
Well, there was a couple specific funds I was
Okay, which ones?
Specific ones?
Yeah.
I'll just give you symbols.
Okay.
You can go direct on these, okay? Oakmark Equity and Income is OAKBX.
OAKBX.
KBX. And then one more is FPA Crescent is FPACX.
FPACX.
Yeah.
And you think these are very good managed funds?
Yes, those are funds where the managers have a ton of money in the fund. They're not restricted to stocks or bonds. They can kind of float around, and particularly Crescent can go even beyond stocks and bonds, and you get a well-diversified portfolio in one fund.
Okay. So if you want to go to index fund, go Vanguard. Excellent way to go.
Yes, it is.
Okay. Please keep in mind these points when you invest in a mutual fund. One is, if you're going to go active, who is the manager? What is their track record? In other words, if you're going to hire Michael, you want to know his track record. How do you do? 2, you want to know the expense ratio. And please keep in mind, there are 12B1 fees, there are loads, commissions. To me, stay in the no-load area. There's over 18,000 mutual funds out there. More load funds than there are no-load funds. So you want to know the expense ratio. Like Warren Buffett says, keep it cheap. 3, you want to know the objective of the fund. Just because you have 10 mutual funds does not mean you have a diversified portfolio. They all may be investing in the same thing. So please keep these points in mind. And I love number 4 is the money manager eating his own cake. You know? They should be. You're literally buying somebody's expertise and choices. Each one of you, if you have an actively managed fund, ought to know who that manager is. So next week, what we're going to do, we're going to start on what we should be doing. We're going to bring in a fee-only financial planner. We're going to talk a little bit about what does it mean to be a CFP, a CFA, and then we're going to go start through as how you ought to approach your own finances. And we'll do that for 2 sessions for next week and the week after. So I think it's cocktail hour. I don't know about you. Okay, thanks for being here today. Michael, thank you so much.